Self-employment taxes can be one of the biggest shocks to a new business owner. No one enjoys seeing those large sums of money being sent to the IRS every couple months, and it's even harder if you forget to plan for those payments. Fortunately, there is a tax election that can be made at the federal level that can help to relieve some of this burden. But that doesn't mean that this is a good decision for every business. Hi, my name is Barrett Young and I'm a partner here at GWCPA. And today in this video, I'm going to talk about the subchapter S election, specifically as it relates to a single member LLC. We're going to go over the tax benefits that go with this election. And we're also going to cover some key things that you might want to consider to determine whether or not you want to make this election. And if you stick around to the end of the video, I'm actually going to cover a few situations where you would not want to make an S-Corp election. First, we're going to ask, what is an S election? So an S election is an election made at the federal level that governs how the profit of a company is taxed and how that taxed profit is then passed through to the owners. So in another video, we talked about an LLC and how that is primarily a state-specific entity structure, and in the case of a single-member LLC, is disregarded for federal tax purposes. An S corporation is almost the reverse. It is a federal tax election that does not have much impact on the state structure of that company. You can actually be an LLC that gets taxed as an S corporation. You can also be a C corporation at the state level that gets taxed as an S corporation. Some of the characteristics of an S corporation are that you are going to be able to compensate owners. So owners will receive a W-2 and be on payroll for the work that they do as an owner. And then they are also going to be taxed on the profit of that company. So with an LLC, all of the net income of the company is taxed for federal income tax and federal self-employment tax. Within an S corporation, the compensation of the owner, which is paid again through payroll and reported on a W-2, that has got FICA, the half of the self-employment tax, Social Security and Medicare tax, only on the compensation of that owner as an operator or as an employee of the business. Everything above that amount is just taxed for federal and state income tax purposes. And so this is the primary savings method of an S corporation. So to go to an example we used in our LLC video, which you can watch here, if a business makes $270,000 net within an LLC, all $270,000 of that income is going to be taxed for self-employment taxes and for federal and state income taxes. If you are within an S corporation, you might say that $120,000 of that $270,000 is owner's compensation. That $120,000 is going to be taxed for Social Security and Medicare and income taxes because it's coming through as a W-2. And then the $150,000 above that $120,000 is going to be taxed as owner's profit. That $150,000 would only be taxed for federal income taxes and then also most likely state income taxes. So as you can see from this example, it can be significant savings involved in having your business taxed as a subchapter S or an S corporation. There are limitations on who can be an S corporation, what type of entity can be an S corporation. One of the limitations is an S corporation cannot have more than 100 shareholders. So it is a small business election. It is not, you will not see public company S corporations where you might see public company partnerships. Publicly traded partnerships. Also, there's a limitation. You cannot have foreign persons be a shareholder in an S corporation. So foreign investment requires either a corporation or a partnership. Another limitation is LLCs cannot own an S corporation. Corporations cannot own an S corporation, and most trusts also cannot be owners in an S corporation. So typically the owners of an S corporation are individuals who own the shares of that S corporation. Whereas with partnerships, for example, you can get very complicated or different entity structures based off of LLCs stacking on top of each other with different ownership levels. Another big limitation of an S corporation is an S corporation can only have one type of stock. So you won't have Class A shares, Class B shares, Class C shares like you would in a corporation. But this also means that if you are an owner of an S corporation and you own 20% of that S corporation, a 20% owner is also entitled to 20% of the distributions from that S corporation. So once the tax return has been prepared and profit is being passed through to the owners, they are taxed on their percentage of the ownership, and then distributions have to be allocated based on the ownership in that S corporation. Whereas with a partnership, you can have distributions are based off of capital, how much capital is accumulated for that partner within the partnership. Those distributions do not have to happen each year. They don't have to happen at the same rate for every partner. And so you could have a silent investor partner who just allows their capital continue to accumulate year after year, never takes a distribution until the partnership is liquidated or they cash out in the future. You can't do that with an S corporation. If $100,000 is distributed to the owners of an S corporation, it has to be allocated according to the ownership within that S corporation. So this can put a cash crunch on businesses where one owner needs the money to come out as distributions, the other one does not. That other owner that doesn't need the money still has to receive it. In a partnership, if you as a partner are signing on the liabilities, the notes in that partnership, you get basis in that partnership from that liability. That does not happen the same way in an S corporation. And so this can definitely impact an S corporation that is debt heavy, where owners in the S corporation are signing on notes and there's a lot of liabilities on that, but then they take out distributions in excess of their basis that they have within the S corporation. That can cause a taxability issue where those distributions in excess of their basis are actually taxed as long-term capital gains, as if the stocks that they are the owners in are passing through capital gains to them because they don't have basis in that stock anymore. So that's something to keep in mind with an S corporation. Another benefit that we want to keep in mind, and this is a more recent benefit, mostly since the Tax Cuts and Jobs Acts of 2017. So in the Tax Cuts and Jobs Act of 2017, the state and local tax deduction, when you itemize, was capped at $10,000. And so you'll have clients in states with large state income tax burdens who no longer are receiving a benefit when their state taxes are $20,000, $30,000, $40,000. So a lot of states with higher income tax rates have been getting around this through what's called a pass-through entity tax election. Maryland instituted this in 2020. Virginia followed suit in 2022. So those are the two states that we deal with the most. If you are a single member LLC, which is a single owner that owns an LLC, it's a disregarded entity, it's filed on Schedule C, you do not actually get to take advantage of this pass-through entity tax because it is a tax that is now paid at the entity level within the state where you reside or where your business resides. So because your LLC is disregarded at the federal and at the state level, you don't get any benefit from that. If you, however, elect to be treated as an S corporation, you now have a separate entity tax return. It is filed on 1120S rather than a Schedule C, and that 1120S will then also have a corporate state tax return that pays the tax at the state level. This pass-through entity tax is deducted at the federal level, and then the owner gets a credit for any taxes paid on their personal tax return. So it's a workaround that some of these states have put in place. I think over 35 states have put this in place since 2017, and it is specifically a benefit that if you are a single member LLC, you would want to be taxed as an S corporation so that you can gain the benefit of this deduction at the federal level. Okay, so since there are so many benefits to being an S corporation, why wouldn't a company want to elect to become an S corporation right away? Probably the biggest drawback that I advise clients is based on the profitability and size of their company. I've seen businesses right out the gate be taxed as an S corporation from day one who make $15,000. I had a client years ago who had a lawn service company. They made $15,000 to $20,000 net income within their business, and they were taxed as an S corporation. The IRS requires that you pay a reasonable compensation to an owner because they know how you're going to want to play those games. And when you're netting $20,000 in your business, it's going to be very hard to say that all $20,000 of that is not reasonable compensation to the owner. And so $20,000 of payroll brings income down to zero. You're not actually gaining any benefit from saving on self-employment taxes in that case. You're actually too small to gain a benefit, and the CPA that puts you into that S corporation now has to prepare a separate tax return for you, which they can charge you a couple $1,000s for an S corporation tax return. Plus, you also have to administer payroll. So you now have the payroll processing costs, you have an additional tax return prep fee, and you're not saving any money on self-employment taxes. So this is the biggest recommendation for why you would not want to be an S corporation, is if your net income number is too small. Generally, once your net income within the business gets to about the $60,000 range, $60,000 to $150,000 is really the sweet spot where you gain the most savings from this. At that $60,000 range, we can start to make a case and say, okay, well, you would pay an owner $45,000 to run this company. The additional $15,000 is going to be owner's profit distribution. You go up from there and you can say, netting $150,000, you pay the owner $80,000, $70,000 might be profit distribution. If you are in a grossly profitable business, attorneys, lawyers, for example, doctors, I've seen companies that might net $400,000, $500,000, $600,000. The benefit from being an S corporation starts to taper off a little bit because you're already above that $160,000 threshold for Social Security tax. So once you're at that threshold, that drops off and you're only paying Medicare tax above that amount, 2.9%. And so if I'm netting $500,000 and I'm compensating the owner within that business $200,000, they're already being taxed on self-employment taxes for that $200,000. You're saving 3% on the difference of $300,000. It's not insignificant, it's just not as big of a benefit once you get to that size company. So that's something to keep in mind. If you are in a company that lots of revenue, not a lot of expenses, the benefit from becoming an S corporation starts to taper off. Still something that you want to consider, especially with that pass-through entity tax. If you're going to be paying 8 or 9% on $500,000 at the state level, you want that deduction, and it still would make sense to become an S corporation. But the self-employment tax portion of it, saving on that amount, starts to wear off a little bit at those higher income numbers. One thing though I will caution you when you consider this is you want to look at your state. Again, you want to have your CPA and probably a tax attorney or a corporate attorney take a look at this benefit for you, because there are some states like Tennessee, for example, that have implemented a S corporation specific excise tax that you would want to take a look at for those states to see if it still makes sense to be a S corporation in your specific state. In general though, if you are a single member LLC where your business is your primary source of revenue and you're making about $150,000, it's probably going to make sense for you to become an S corporation in that case. Some of the other cases that we already talked about where it might not make sense for you to be an S corporation include those companies where you have a silent investor where they're going to be able to take out a distribution every year. If a shareholder takes a distribution, all shareholders take a distribution. So that's something to keep in mind. Also, because of the nature of an S corporation, it doesn't make sense to elect to become an S corporation if you have a passive type of business, if you're doing real estate investment, or if you own a building that your law firm rents from your other LLC. You wouldn't want that LLC to be taxed as an S corporation because you're really not gaining as much benefit because it's passive income, it's not subject to self-employment taxes. So that's something to keep in mind as well there. I already talked about debt-heavy companies, companies that borrow a lot of money. If you have distributions in excess of basis, that can create issues there as well. And then the last thing that you want to keep in mind is that it is slightly harder, more complicated to bring new shareholders into an S corporation than it might be to bring partners into an LLC. And there are also specific partner tax elections that you can make when you change around the ownership structure of an LLC or a partnership that are not available within an S corporation. So again, consult your attorney to make the determination. Don't just assume S corporation saves you a couple $1,000s in self-employment taxes, so it's a no-brainer. You do want to consider your own situation and see if this is going to make sense for your situation. As you can see, the decision to become an S corporation is a case-by-case decision that needs to be made with wisdom and a little bit of consideration of the upsides and downsides. If this video has been helpful for you, please like this video and watch this one next, where you can see some tax moves within your financial statements that impact the value of your company. Thank you very much.